Thank you. So that's a new thing that Zoom's done is they put that on there. I don't know why.
Right.
Because I want to make sure everybody knows that it's recording. Hey, Lisa Laday-Davis, how are you doing?
Hi, doing well.
Wow, I miss seeing you.
Same here.
How's work going? Everything going well?
Everything is pretty busy. You would think that we've passed tax season, that things would slow down a little bit. It has not. So we're still going strong.
So do you think a lot of people have deferred their tax filing until later on today, later on this year?
I think there were, even though we had an extended due date for 2021, there were probably just as much and a little bit more people still putting it on extension. For one, all the changes that came down at the last minute was confusing to a lot of people.
Yeah,
Stimulus
exactly.
payments, everything. So they really wanted to take the time to get it right. So especially if you have a small business, a lot of people did put it on extension with all the SBA funds and everything out there. They wanted to make sure they had the time to go through that in more detail.
And also with the new administration, I'm sure, I don't know if they had a chance to change some tax laws, but I'm sure the tax laws have affected the way people pay taxes or something, right?
Yes, the changes has not come down yet, but we're expecting them. We're already
Yeah.
trying to, you can't tax plan for the unknown, but we're trying. We know some things are going to change in the capital tax gains rate likely. We know things are going to change likely in the corporate tax rate. So we're just waiting, we're hearing kind of what the administration favors
Right.
and what they're going for. And so we're just trying to incorporate that into some what ifs.
Excellent. Yeah, it's definitely interesting to be a CPA nowadays.
Yes.
So I actually asked you to come over or come on and talk about the capital gains tax and real estate, because I've had this question asked to me many times. I don't know what's going on now that people are so concerned about it, but I know what's going on. People, the market is good, and people must want to sell their homes. And I've had a couple of clients who actually have wanted to sell their homes after owning it for like a year and a half. So I think that's when those questions have come up. Can you shed some light on the capital gains tax and how it relates to people selling their homes and what implications there are?
Sure. Yeah, you made a good point. For people that have been in their home less than 2 years, their tax situation is totally different than someone who may have been in their home 2 or more years or 2 out of the last 5 years. So based on the Tax Relief Act that was signed back in 1997, it gave basically a waiver or you don't have to pay capital gains tax if you're a single individual on 250,000 of gain. So that's not your sales price, but that's your sales price over your original cost in the property plus any capital improvements you put into the property.
So if you purchase a house for $100,000 and you want to sell it a year and a half later and it's worth $350,000,
then if it's a year and a half later, you don't get that waiver, you don't get that exemption. You have to pay full capital gains on that. So the exemption is only for people who've been in their house as their primary residence 2 out of the last 5 years. So there's a 250 exemption for single, 500,000 for a married couple. If you've been in your house less than 2 years, that is taxable capital gains. You do not get that exemption. The capital gains tax rates varies based on your income. So lower income, 40,000 or less for a single, or 80,000 or less for a married couple, you may pay 0% capital gains rate. But as your income goes up, that capital gains rate first goes to 15%, then at a max of 20%, and then you're probably going to pay an extra 3.8% for the higher income earners on that as well for net investment taxes. So, I mean, you could be looking at federal rates alone, 23.8% in capital gains tax rates, plus what you're going to pay to the state.
Wow. And is there a cap? You said there was the cap. Is there a cap to or a minimum to the price of the house? Did you say that?
No, the cap has to do with your income. So if your gain on the house, if you fell under that exemption, you can 250 to 500 is exempt. Any gain above that is then taxable. If you've been in the house less than 2 years, there's no minimum. Any capital gains is going to be taxable at all. But keep in mind, Your capital gains is based on the original purchase price of the home plus any capital improvements you put into it. So if you finished your basement, if you made any major improvements, replaced your roof, those are all costs you can add to the basis of the home, which will then lessen your gain as you calculate it on the capital gains.
Gotcha. So
So people
if
should
I
track those.
so if I purchase a house for $200,000, let's say,
Mhm.
and I put 20,000 in roof cost and
Mhm.
50,000 in basement, that's $70,000. I can add that to $200,000,
Yes.
and then if I sell my house for 500,000, year and a
Mhm.
half from now, it'd be
Your gain is,
500,000 less than 270.
yes, your gain is the 230, and that's what you'd pay taxes on.
And
Likely at the 20%.
at the 20%. Okay.
Mhm.
Again, is there a income level?
So 20% is the highest rate you're going to pay on capital gains, and that's if it's a long-term capital gain. So you need to be in the house more than a year to get
Right.
that long-term rate. If you're in the house less than a year and you sell, you're going to pay taxes as your ordinary tax rate. So depending on where your income is, that ordinary tax rate could be as high as 36, 37%. If you're in the home less than a year, you really want to be careful about calculating that capital gains and what that maximum taxes might be if you sell. Some people, it may be better just to wait a little bit longer if you can to make that year before selling.
How does that come into effect with investors? So investors who buy and sell house
So that's a
on a
good
regular
point.
basis.
Mm-hmm. So if it's not their primary, you see some investors that, they buy and sell homes. And if they have a particular home that they think they're going to eventually sell and get a really good significant gain, you might see some of those investors live in that home 2 out of the last 5 years and use that as their primary residence to get some of that gain exempt. Other than that, they're paying the gain on the property based on their cost basis, any money they put into it. If they depreciated the property while they were reporting your taxes over the year, they're going to have to pay normal tax rate on that depreciation recapture. So basically, we recapture depreciation. They're going to pay that at their normal tax rate, and then anything above the depreciation recapture as a gain is then taxed at the capital gains rate, unless they use the 1031 exchange, invested into new like-kind property within a certain time period, and then that gain can be deferred.
And that's a good segue to my next question. The 1031 exchange is also some confusion with especially with new buyers about that program. How does that work?
So 1031 can get very complicated. One thing you should be aware of, or your buyer should always be aware of, it does not work with your primary residence. It's only for commercial or investment property. So when you sell a property, and say you bought a house for 200,000, you sold it for 400,000, and it was investment property, you have a $200,000 gain.
Right.
As long as you invest that into a like-kind property. So if you were holding that property for rental and you were renting it out, you need to invest it into a like-kind property for rental. So you can't go from investing into it's like a personal residence that you're renting out. You can't go from investing in that into a commercial building. It has to be like-kind property, and then that gain gets deferred until the next sale and the next sale and so on.
So I can't do a 1031 exchange on my primary residence.
No. It's only for property held for investment or for commercial purpose.
That's good. Okay, I got that.
Unless you turn your primary residence into rental real estate for a time period. I think it has to be at least over a year.
So question about that. So what if I turn my primary residence into an Airbnb?
Well, that's a good question. If you turn it into an Airbnb, it's considered rental property. As long as you're not using that for personal use over so many days a year, it'll still qualify as, commercial or property held for business or investment.
So it would have to be Airbnb or rental property full time. I can't. I
Yes.
can't. Dang it.
Yeah, you
Okay.
can't go back and forth. Sorry.
All right. Let's go back to the capital gains. Is there a age limit on capital gains? Like, can at what age do home sellers not have to pay capital gains?
You know, before 1997, there was an age, there was an exemption based on age. So if you were 55 or older, there were certain
Yeah.
exemptions. Those no longer exist.
No.
There is no age limitation. If you're retired in 70, you're going to pay the same capital gains rate as someone else that's in the same tax income bracket that may be 35. So.
Oh, really?
Yeah.
Okay. Well, that stinks.
Yeah. Yeah,
And
hopefully by the time you're in retirement, your earned income's lower and it pushes it into that lower capital gains tax rate because there's not a lot, you know, you don't have a lot of that W-2 or earned income coming in. So
that's true. Is there a difference for 1099 and W-2? I mean, is there?
No, it's all going to count as earned income as long
Earned
as
income?
it's earned income. Mhm.
Okay. And my last question before I let you go, what are the tax advantages of owning a home? What would you say the tax advantages are? in today's market?
Itemized.
Oh, yeah?
So basically, with the last Tax Cuts Act, there was an increase in the standard deduction. That increase in the standard deduction had a lot of our clients that were itemizing before, no longer itemizing. So basically, if you're filing as a single individual, your standard deduction is $12,400. If you're head of household, that standard deduction is a little over $18,000. Married filing jointly, it's 24,000, I think 400 or somewhere around that number. So to itemize, your itemized deductions have to exceed the standard. So by the time you add the interest you're paying on your mortgage, your property taxes, as well as your state income taxes that you paid during the years, not to exceed $10,000. So 10,000 is a cap that. So a $10,000 tax cap plus interest plus charitable contributions plus medical expenses if it's over a certain dollar amount, all those items have to add up more than the standard. So a married couple, more than 24,000 before you can itemize.
Gotcha.
That was the biggest benefit of owning a home, was being able to write off and to itemize, take a bigger deduction, have more of your income non-taxable. That benefit's been removed for a lot of people because when they raise that standard, a lot of people don't get up to those 24 or 18,000 once you combine all those expenses together. So it's important to do the analysis. If you can get over that standard deduction, it's a great benefit to be able to itemize. It not only benefits you on your federal taxes, it'll benefit you on your state taxes as well.
Gotcha. Excellent. Hey, Lisa, thank you so much for your time. I'm going to let you go. It's Friday, right. and I'm sure you want to go home now.
Yeah, right.
So let me ask you a question. How can people get hold of you?
Sure, they can check our website out at KennesawCPA.com. They can give us a call at 678-662-8708, or they can email me directly at lisa.davis@KennesawCPA.com.
You're the best. Thank you so much, Lisa. Thanks for your time. I appreciate your knowledge.
No problem.
Talk to you soon. Bye-bye.